the reality of being 99 years old. Right now, I am 99. I have seen a lot and lived through 18 recessions. Maybe more, I've lost count. I have witnessed wars, depressions, and financial manias that would make your head spin. I've seen booms and busts that wiped out so-called smart people from the face of the earth. And I'm going to die soon. This isn't a guess, and it's not for dramatic effect. It's pure arithmetic. At 99, you don't buy green bananas. I don't have time to waste on financial nonsense. I don't have time for complex theories or polite fictions. And at 60, neither do you. The biggest mistake you're making isn't picking the wrong stock. It's believing that you have time. You don't. At 60, your time horizon for recovery is 0. It's gone. A single major mistake that a 25-year-old would laugh off will finish you. It will permanently change the quality of your life and the lives of your children. I'm going to list 5 catastrophic mistakes that mathematically guarantee people over 60 will go broke. This isn't about getting rich. That game is over. This is about not dying in poverty. Stay with me. Most people over 60 think they have 2 bad options. Either take significant risks in complex growth stocks to outpace inflation, or hide in cash and watch their purchasing power evaporate. They are told they must stay in the market or search for yield to survive a 30-year retirement. This line of thinking is fundamentally wrong. It is exactly how people go broke right when they can least afford it. At 60, the game is over. You are no longer accumulating, you are preserving. The math of compound interest in reverse is brutal. A 50% loss requires a 100% gain just to break even. You simply do not have the time for that kind of recovery. True safe growth isn't about finding the next 10-bagger or timing the market. It is about the ruthless elimination of any possible scenario involving the permanent loss of capital. You are in the final, most critical decade of compounding, and you cannot recover from a serious setback. The standard 60-40 or 70-30 portfolio is often a trap set by advisors who don't have to live with your consequences. I will show you 5 catastrophic mistakes people over 60 make that mathematically guarantee they will outlive their money. Avoid them, and you will ensure your capital survives with you, not just for you. The first mistake is the most common. Mistake number 1, the yield trap. This is the siren song for new retirees. You stop working, your paycheck stops. You look at your pile of money, your safety net, and you think, how do I make this pay? I need income. So, you go hunting for yield. This is almost always a catastrophic error. The damage comes down to simple arithmetic. First, chasing high yield, anything above 5% or 6% in normal conditions, forces you into mathematically riskier assets. These aren't strong, boring companies. These are junk bonds, high-debt real estate investment trusts, REITs, that own dying shopping malls. These are businesses with shaky foundations. Second, you must understand what high yield actually represents. The market is not a charity. It is not your friend. It doesn't give you 8% for free. If the yield is high, it's because the market is pricing in a high probability of default. It's pricing in dividend cuts. It is pricing in the very real possibility that your principal, your starting capital, will be cut in half. High yield is a warning sign, not an opportunity. It is a distress signal. Third, it ignores total return. This is the part everyone forgets. A 10% dividend is completely useless if the stock drops by 40%. You got your $10,000 in dividends, but lost $400,000 of your principal. That is a fool's trade. But people make it every single day because they are hypnotized by the word income instead of the math of total return. Let me tell you a story. There was a dentist, 67 years old. He had just retired and moved to Miami, Florida. He had done well, sold his practice, and had about $2 million in his retirement account. This was around 2021. Do you remember 2021? Interest rates were at 0. You got nothing in a bank account, nothing from treasury bills. But this dentist had his Miami lifestyle, his condo, his yacht club. He calculated he needed about $100,000 a year to live. Well, that's 5% of his $2 million. So, he goes to an advisor. The advisor, of course, says 5% is easy. In 2021, everyone was a genius. People were getting rich on nonsense. The dentist felt he was being too conservative. The advisor builds him this high-income portfolio. It's full of stocks with 8% dividends, businesses with shaky balance sheets, and leveraged REITs paying 9%. The dentist is thrilled. He feels smart. He feels like he's beating the system. He's getting his income, and the market is still going up. Then came 2022 and 2023. The Federal Reserve raised interest rates faster than ever in history. And what happens to high-yield, high-debt assets? When interest rates go up, they crash. It's just gravity. The financing costs for those leveraged REITs exploded. They had to slash dividends. Those 8% stocks were risky assets, and they were repriced overnight. His $2 million portfolio dropped to $1.2 million, a 40% loss. And the worst part? The income he was chasing was cut anyway. Those dividends vanished, so now he had a portfolio worth $800,000 less, and it still wasn't generating the income he needed. He's 70 now. I'm told he's looking for part-time consulting work. His wife says he never puts his phone down at the dinner table. He's always checking the market, always hoping for a recovery that isn't coming. He didn't just lose money. He lost his peace of mind. He lost his retirement. The lesson is this. The market is not a charity. It doesn't give you 8% for free. If the yield is high, the risk is high. You cannot afford to risk your principal for a little extra income. A safe 3% return from a great asset is infinitely better than an 8% gamble that leaves you broke. This trap leads directly to the second mistake, which is even more insidious. Mistake number 2, miscalculating the time horizon. This is the most damaging lie in the financial services industry. You go to an advisor at age 60 and say, "I'm retiring." He pulls out a chart. He says, "Good news. You have a 30-year time horizon." He shows you actuarial tables. You'll probably live to 90 or 95. Therefore, he says, you can afford to take risks. You can afford to keep 60% or 70% in stocks. You have time to recover. This is fundamentally and dangerously wrong. Your spending time horizon is 30 years. Your loss recovery time horizon is, if you're lucky, maybe 3 to 5 years. A 25-year-old kid who gets hit by a 50% market crash, like in 2000 or 2008, will be fine. He's happy. He just keeps buying. He keeps putting money in from his paycheck every 2 weeks, buying at the bottom. His time horizon is real. When you are 65 and hit that same 50% crash, what happens? You don't have a paycheck. You aren't buying. You are selling time. You are selling stocks at the absolute bottom month after month just to pay for groceries. You are locking in irreversible losses. You don't recover. You are destroyed. I've seen it happen over and over. I'm 99 years old. Warren is 93. We've been doing this a very long time. People ask us, what's the secret? It's not genius. We simply avoided being stupid. Look at the crash of 1973 to 1974. It was brutal. The market fell nearly 50%. Inflation was raging. It was stagflation. It was the end of the world. According to the papers, people who were fully invested at age 65 in 1973 were wiped out. They followed their advisor's advice. They owned the Nifty 50, the one-decision stocks you were supposed to buy and hold forever. Companies like Xerox and Polaroid were considered infallible. People paid 60 or 80 times earnings for them. They believed their own story. When the crash hit, these infallible stocks dropped 50, 70, 90%. People were ruined, forced to sell for pennies. Warren and I were 50 and 43. We weren't ruined. Why? We had cash. We were sitting on cash from our insurance companies, from blue-chip stamps. We waited. We weren't trying to time the market. We were just waiting for the inevitable moment when the world would go crazy and offer us bargains. We didn't need to recover because we weren't stupid. We didn't lose our principal. And while everyone else was broke, while they were selling us their best assets, we were buying. That was when we bought the Washington Post. That was when we bought some of our best assets. We bought them from people who were forced to sell, people who miscalculated their time horizon. People who understand their true time horizon have cash. They have liquidity. People who don't are forced to sell to people like me. The lesson is that your time horizon isn't your life expectancy. It's the time you have until the next major bear market. Can you live for 5 years without selling a single share of stock? Can you pay all your bills for 5 years of a brutal downturn without touching your principal? If the answer is no, your time horizon is too short for the risks you are taking. This mistake is often driven by the next one: diversification. Mistake number 3, over-diversification. I call it diversification. This is another masterpiece from the consulting industry. They tell you it's the only free lunch. They show you modern portfolio theory. They want to lower your risk. So what do? They put you in 40 different mutual funds. You get a statement 50 pages long. You own a U.S. large cap growth fund, a U.S. large cap value fund, a global dividend fund, and an emerging markets fund. You feel safe. You feel sophisticated. You've been conned. First, this guarantees mediocrity. When you own 40 funds, you own everything. You own all the bad companies along with the good ones. You are guaranteed an absolutely average return minus the high fees you pay for the privilege. Second, and this is critical for someone over 60, it does not protect you from a systemic crash. It is an illusion of safety. In 2008, all 40 of those funds went down together. In 2022, they all went down together. Your diversification didn't work when you needed it most. Why? Because you weren't diversified at all. You just owned the same risk in 40 different packages. I see this all the time. Think of an engineer, a successful software engineer from Austin, Texas. He's 62. He's getting ready to retire. He has $4 million. He thinks he's a genius. He thinks he's diversified. He tells me, "Charlie, I have 20 different tech funds, and I own the S&P 500. I look at him and say, You don't own 21 things. You own one thing. He's confused. I explain what's in the S&P 500. It's mostly just 7 giant tech stocks. What's in your 20 tech funds? The same 7 giant tech stocks. His entire diversified $4 million portfolio is just one bet. A bet that US megacap tech stocks will go up forever. When that bubble bursts, as they always do, his entire portfolio will drop 60% in unison. His advisor shows him a beautiful pie chart with 15 different colored slices. It looks so professional. Global Tech, US Innovation, Disruptive Growth Fund. The engineer, a very smart man in his field, is impressed by the complexity. He thinks it's sophisticated. He doesn't realize it's all the same risk. It's just a handful of Silicon Valley stocks wrapped in 15 different labels. The advisor created an illusion of safety through complexity. That isn't diversification. It's diversification. The lesson is that real diversification isn't owning 100 stocks. It's owning 3 or 4 different kinds of assets. A US Treasury bill is not a tech stock. A good apartment building that you own and understand is not a junk bond. Owning 500 stocks in an index just guarantees you own 450 bad ones. I would rather own 3 great ones that I understand. If you can't find 3 or 4 great, safe, distinct assets, then you wait. You sit in cash. That is better than buying a basket of mediocrity that will fail you in the first real storm. But the real psychological trap is the next one. Mistake number 4. The recovery fallacy. This is psychological poison that finishes people off. It's the simple arithmetic we discussed earlier, but people cannot accept it. A 50% loss requires a 100% gain to get back to even. If your $2 million portfolio drops to $1 million, you don't just need it to go up again. You need that remaining $1 million to double. You need a 100% return just to get back to where you started. At 65 or 70, you don't have time to wait for a 100% gain. It could take 10 years, 15 years, or it might never happen. But people cling to the old price. They look at their statement and see that a stock they bought for $100 is now worth $50. They tell themselves, it's just a paper loss. I haven't lost anything until I sell. I'll just wait until it gets back to $100. This is a disaster. This is how a temporary loss becomes a permanent catastrophe. I remember an executive I knew, a smart man who ran a factory in Chicago. This was back in 1999. He was 59 and about to retire. He had $3 million. He had done everything right. His portfolio was full of safe blue chips: Cisco Systems, General Electric, Intel. These were the gods of the market. You couldn't lose. Then the dot-com bubble burst. From 2000 to 2002, his portfolio was gutted. It fell nearly 70%. His safe stocks were destroyed. But he was smart. He couldn't accept this new reality. He sat there and told his wife, "It's just on paper. It's hysteria. This is GE, this is Cisco. These companies are the new economy. They'll come back. We're just holding on." He refused to sell. He tied his ego to the decision. Selling meant admitting he was wrong, admitting he had been a fool. He believed the loss was recoverable because he needed to believe it. His entire concept of retirement depended on it. He waited and waited. He waited 15 years. It never came back. General Electric, that titan of industry, collapsed to pennies. It was a joke. Cisco never saw its highs again. He ended up working until he was 72. He had to. His $3 million never recovered. He spent the last decade of his life living on a fraction of what he had planned, all because he couldn't accept the reality of a loss. I imagine he still has the paper stock certificates somewhere for companies that barely exist, a monument to the recovery fallacy. The lesson: simple arithmetic. At 60, any 50% loss is permanent. Period. Game over. Your entire strategy must be to avoid every scenario that could lead to a 30 to 50% loss. You are no longer in the game of investing. You are in the game of survival. Which brings me to the last mistake. Mistake number 5, the advisor competence fallacy. This is the one that triggers all the others, the last and most dangerous error. This is the mistake that ties everything together. You worked your whole life. You saved. You're 65. You're nervous. You don't want to make a mistake. So, you do the responsible thing. You hire a professional. You find a financial advisor at a big, impressive bank with a marble lobby. You outsource your survival to someone who is statistically mediocre. Worse, you outsource it to someone whose incentives don't align with yours. How does your advisor get paid? He either gets a commission for selling you a product, or he gets a fee based on your assets under management. If he sells you a product, he's a salesman, not your partner. He sells you what earns him the biggest commission, not what is best for you. If he charges a fee, say 1% of your assets, what is his incentive? To protect your capital? No. His incentive is to collect your capital. And once he has it, his incentive is to put you into a standard, cookie-cutter, 70-30 portfolio model that is easiest for him to manage. He uses the same model for everyone. Why? Because it's within his circle of competence, not because it's right for you. He doesn't have to live with the consequences. You do. He still gets his 1% fee even if your portfolio drops 35%. He gets paid for failure. It's a crazy system. Think of a woman from Pasadena, a retired school principal. She's 70. This was before the 2008 crisis. Her husband had passed away, leaving her $500,000. That was everything. She was scared. She did what anyone would do. She went to a nice man at a big, famous bank. The bank's name was on a skyscraper. It was a name her husband trusted. The office was marble. He was kind. He spoke in a quiet, reassuring voice. He had plaques on his wall. President's Club. She didn't just trust him. She trusted the institution, the brand. He put her in their balanced portfolio. He said it was safe and prudent. He said, "This is what we do for all our clients in your position." It was a standard canned response. In 2008, that balanced portfolio dropped 35%. She lost over $150,000. She was in a blind panic. She called him. He told her to stay the course. He told her it would come back. There it is again, the recovery fallacy. No, she was 70. She needed to live. She had to keep withdrawing money month after month to pay her bills. She was selling her assets at the absolute bottom. She crystallized those losses, making them permanent. She never recovered. She's 85 now. She lives with her daughter. The advisor? He's fine. He probably got a promotion. He collected his 1% fee every quarter all the way down. The lesson: you must know more than your advisor. You must be able to check his homework. If you hire someone to manage your money, you are still 100% responsible for the result. Trust, but verify the arithmetic. If you don't understand it, don't do it. Why am I so obsessed with avoiding loss? To me, this isn't an academic question. It's not theory. It happened to me in the early 1960s. I was running my own investment partnership. I had learned from Ben Graham. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. It sounds simple, but for me, it wasn't a reality until 1973 and 1974. The market was cut in half, down 50%. I was 50 years old, and I saw people who were smarter than me go broke, completely broke. Berkshire, blue chip stamps. We weren't cut in half. Why? Because we didn't own the popular junk. We didn't chase the nifty 50. We held cash. We sat on piles of cash from our insurance companies. And while everyone in the world was in a panic and forced to sell, we were buying. That was when we bought the Washington Post for pennies. That was when we bought our best assets. We bought them from people who didn't have cash, people who were leveraged, people who were stupid. That's when I realized that surviving a crash is the only thing that matters. Growth, compound interest, all of that will take care of itself if you don't get wiped out first. Preservation is the foundation for all opportunity. That experience taught me the rules, my rules for survival. My rules aren't about growth, they're about not dying. So here are the rules. They are simple. Rule 1, stop the hunt for yield. Your job is total return, not current income. If you need cash, sell 3% of a great asset. That's fine. Don't buy a bad asset with an 8% yield. Rule 2, your time horizon is 3 years, not 30. You must be able to live for 3 to 5 years without selling a single stock during a downturn. That means cash. Cash isn't trash. Cash is oxygen. Cash is your power to wait. Rule 3, flip the loss formula. Don't ask, how much can I make? Ask, how much can I lose? If you can lose 50%, you will eventually lose 50%. Avoid that scenario at all costs. Rule 4, buy 3 things, not 300. Find 3 to 5 assets that you fully understand, which cannot go to zero. A great monopoly business that you understand. That's it. Forget diversification. It sounds simple. Let me show you what it looks like when someone does it right. I knew a woman, a high school history teacher. She never earned a huge salary, but she was prudent. She saved. She retired at 65 and ignored all the noise. She ignored the advisors. She didn't chase yield. She bought 3 things in her life. First, her home. She paid it off. 0 debt. Her cost of living was low. Second, a simple S&P 500 index fund. She put money into it for 40 years and never, ever touched it. Third, when she turned 60, she took 40% of her savings and put it all into U.S. Treasury bills. Short-term Treasury bills. Safe, liquid. Then came 2022. The S&P 500 dropped 20%. Stocks were crashing, bonds were crashing. Was she in a panic? No. She lived off her treasury bills. She paid her bills from her cash. She didn't sell a single share of her S&P 500 fund. She just waited. She avoided irreversible loss. Now she's 75. Her S&P fund is worth more today than when she retired. She hasn't lost a single night of sleep. Now compare her to the dentist from Miami. The dentist who chased yield and lost 40% of his principal. He's looking for a job. The teacher is traveling. She wasn't a genius. She just wasn't stupid. Let me tie it all together. Remember the mistakes. Chasing yield, miscalculating time, diversification, believing losses are recoverable, and trusting an advisor who sells you the other 4. At 60, the formula isn't about growth, it's about arithmetic. The formula is survival capital plus a few great assets. Survival capital is your living expenses for 3 to 5 years in cash or treasury bills. That is your real-time horizon. That is your oxygen. Great assets are 3 to 5 things you understand that can't go to zero. Your home, a great business, an index fund you'll never sell in a panic. That's it. That's the whole game. I am 99 years old. I won't live to see the next crash. No, you will. You're 60. You're 70. You are in the game of preservation. Don't be stupid. Don't lose your money. You don't have time to earn it back.